Today is Wednesday, March 4th, 2026, and gold just crashed from $5,800 to $4,600 in less than 6 hours. $200 wiped out in a single session. If you are watching this right now and your stomach is in knots, I understand, but you need to stop, breathe, and watch every second of this video. Because what just happened to gold makes absolutely no sense. The numbers tell a completely different story than what you are being shown. Gold just crashed 21% in one session. The biggest single-day drop in over 4 decades. And yet, right now, at this very moment, gold refineries across Europe have stopped taking new orders. The LBMA vault system in London is reporting delivery delays of up to 6 weeks. Let that land for a second. The price is crashing, but nobody can actually get the product. In any functioning economy, a price crash means supply floods the market. Sellers rush in, shelves fill up, buyers have options. That is not what is happening here. Here, the price is collapsing while availability is disappearing. These two things cannot both be true in a real market. One of them is a lie. Welcome to the hidden economy, where I pull back the curtain on what is really happening while mainstream media reads you the script. If this is your first time here, subscribe immediately because this is the analysis they do not want you to see. Now let me show you the evidence, and I want you to understand that each piece alone might seem explainable, but together they paint a picture that should terrify you. Start with Switzerland. Switzerland is home to 4 of the world's largest gold refineries: Valcambi, Pamp, Argor Heraeus, and Metalor. Together, they processed nearly 70% of the world's gold. On Tuesday morning before the crash, when gold was still hovering near $5,700, all 4 refineries sent notices to their wholesale clients. The notices used different language but delivered the same message. New orders are paused until further notice due to unprecedented demand backlogs. Read that again, slowly. Unprecedented demand backlogs when gold was at $5,700 before the crash even started. Then the crash happened. Gold dropped from $5,800 to $4,600. A $1,200 gift, a 21% discount. What do you think every smart investor on the planet did? They tried to buy. Every single one of them rushed to buy physical gold at this once-in-a-decade discount. And they found empty shelves. The crash did not create supply. The crash created a tsunami of demand, hitting a market that was already bone dry. This is not how real economies work. Now, let me take you to the United States. The Federal Reserve holds the world's largest official gold reserve, over 8,000 metric tons stored at Fort Knox in the New York Fed. For months, there have been growing requests from foreign governments to repatriate their gold stored in New York. Germany took years to get theirs back. Now, Poland, Hungary, and several Gulf states have formally requested accelerated repatriation. The requests are being delayed. Why does that matter? Because it tells you something critical about the physical gold market. If the gold was there, easily accessible, the transfers would happen quickly. Delays suggest the physical gold is not as available as the official numbers claim. This is not conspiracy. This is a pattern. The same pattern we saw with silver. The same pattern we see every time paper promises confront physical reality. Now, let me show you Japan. The Tokyo Commodity Exchange, TOCOM, tracks gold warehouse receipts, the physical gold backing futures contracts. In the past 30 days, TOCOM registered gold inventories have fallen 34%. 34% in 1 month. That is not normal drawdown. That is panic-level physical withdrawal. Someone, or multiple someones, is pulling physical gold out of the system at an extraordinary rate. And here is what the mainstream media will not tell you. The entities pulling this gold are not retail investors. Retail investors do not have the infrastructure to take delivery at this scale. These are institutions, sovereign wealth funds, and central banks. The people who understand the system best are getting out of paper and into metal. While you are watching a number on a screen go down, they are loading physical gold onto armored trucks. Let me explain how the gold market actually works, because most people watching this have never been taught the truth. There are 2 gold markets operating simultaneously, and they are telling completely opposite stories right now. The first is the paper market. COMEX in New York, LBMA in London. This is where hundreds of billions of dollars in gold trade every single day. But almost none of it involves actual gold. It involves contracts, derivatives, promises, financial instruments built on the assumption that most people will never demand real metal. The second is the physical market. Mints, refineries, dealers, vaults. This is where actual gold changes hands. And right now, this market is seizing up. For decades, the paper market has set the price of gold. Banks trade paper gold in enormous volumes, and that trading determines the number you see on your screen. But the paper market can only work if people believe the paper is as good as the metal. That belief is breaking down, and when it breaks completely, the paper price becomes irrelevant. What matters is what someone will actually pay you for physical gold in the real world. Now let me tell you about the lease rate explosion. Gold lease rates, The cost to borrow physical gold have spiked to levels not seen since the 2008 financial crisis. Some markets are reporting rates above 5%, which is extraordinary for gold. High lease rates mean one thing: physical gold is scarce and hard to borrow. The people who hold physical gold are demanding huge premiums to lend it out. This is a distress signal from inside the market. When lease rates spike, it confirms what the empty shelves already show us. There is not enough physical gold to meet demand. The system is under stress. Now let me connect this to the broader economy, because this crash did not happen in a vacuum. 3 days ago, the U.S. Treasury reported that foreign central banks reduced their U.S. dollar reserves by $340 billion in the past quarter, the largest quarterly reduction on record. When central banks reduce dollar reserves, they typically move into one of two things: other currencies or gold. The dollar is not gaining against other currencies right now, so where's that $340 billion going? It is going into gold, or it is trying to. And the physical gold market cannot handle that level of demand. This is why refineries are pausing orders. This is why vaults are being drained. The entire global monetary system is quietly pivoting away from the dollar, and gold is the exit door. But the exit door is too small. Too many people are trying to get through at once, and the paper market is crashing the price of gold at the exact moment the physical market is running dry. Think about that. The price of gold is falling while demand for physical gold is at historic highs. Either the price is wrong or the demand is wrong. Look at the empty shelves and decide for yourself. Now I want to talk about who is doing the selling, because the selling pattern in this crash is identical to every manufactured gold decline I have tracked over the past decade. Nearly all of the aggressive sell orders hit during a 90-minute window at the opening of New York trading. The same window, every day this week. Billions of dollars in paper gold dumped into the market at exactly the moment designed to cause maximum price impact. This is not organic selling. Organic selling does not happen in coordinated waves at the same time every day. This is algorithmic, institutional, deliberate selling. Someone is pushing the price down on purpose. Meanwhile, during Asian trading hours, gold stabilizes or rises slightly. During European hours, it drifts. Then New York opens, and the hammer falls again. The West sells paper. The East buys physical. This pattern has played out in silver, in oil, and now in gold, with greater intensity than ever before. Let me show you China's role specifically. The People's Bank of China has been the largest official buyer of gold for 18 consecutive months. They report their purchases with a delay, and even those reported numbers are believed to dramatically understate actual accumulation. China has also been quietly encouraging its citizens to buy gold through state-owned banks. Television commercials, billboards, official government messaging, all pointing citizens toward physical gold ownership. This is not a coincidence. This is preparation. India is absorbing every ounce it can find. Indian imports of gold through unofficial channels, what economists call the gray market, have exploded. When official channels run dry, buyers find unofficial ones. Demand does not disappear. It just moves underground. The Middle East is converting petrodollars into gold at a pace that is rewriting trade flows. Dubai gold dealers are reporting premiums of 35% over the paper price. The paper says $4,600. Physical buyers in Dubai are paying $6,200. Read that again. $6,200 for physical gold when the paper price says $4,600. That is a $1,600 premium. That is a 35% premium on top of a price that already crashed 21%. That premium is the real market speaking. That premium is what gold actually costs when you try to buy it in the real world. Now let me give you the historical context that makes this truly alarming. In 1971, Nixon closed the gold window, ending Bretton Woods. Before that happened, foreign governments were draining U.S. gold reserves at an accelerating rate. Sound familiar? In 2008, during the financial crisis, gold lease rates spiked and physical premiums exploded even as the paper price crashed. Then gold tripled in the following 3 years. In 1980, the paper-physical disconnect in gold was so extreme that the market had to reset violently. The reset was brutal, fast, and enriched those who understood what was happening. History does not repeat exactly, but it rhymes so loudly right now that you would have to be deliberately not listening to miss it. Let me tell you what this means for you personally. If you hold physical gold, do not panic sell. I repeat, do not panic sell based on a paper price in a paper market that is visibly disconnected from physical reality. Your gold is worth what someone will actually pay you for it. And in Japan right now, that is $6,000. In Dubai, that is $6,200. The paper price is a distraction designed to scare you into selling. If you hold gold ETFs or paper gold products, you need to understand something important. You do not own gold. You own a claim on gold. And if everyone tried to redeem those claims simultaneously, there's not enough physical gold to honor them. This is not theoretical. The ratio of paper gold to physical gold in the COMEX system is currently over 300 to 1. For every 300 paper ounces, there's 1 real ounce. If only 1% of paper holders demanded delivery, the system would collapse. If you're looking to buy physical gold right now, understand that premiums have exploded. Be prepared to pay significantly above the paper price. The paper price is a fiction. The premium is the reality. And here is the perverse logic of this crash. The lower the paper price goes, the more physical gold disappears. Lower prices trigger more demand. More demand drains more physical supply. The crash is accelerating the very shortage it claims to represent. There is a word for this in economics. It is called a market failure. When price signals move opposite to supply and demand fundamentals, the market has failed to perform its basic function. The gold market has failed. The paper price is not telling you what gold is worth. It is telling you what banks want you to believe gold is worth so that you sell yours at the bottom. Do not sell at the bottom. Understand the game. Be the one who holds while others panic and accumulate when others flee. This is the hidden economy. The real story is never on the surface. The real price is never on the screen. The real market is the one where physical metal changes hands, and that market is telling you something very different from what CNBC is reporting. They crashed gold. The world is scrambling for every ounce, and you get to decide right now which side of that equation you stand on. Subscribe, hit the notification bell, and drop a comment below telling me whether you think this paper-physical disconnect ends with a bang or a slow unraveling. I read every comment, and your answers shape what I cover next.